Good day everyone and welcome to this update on aggressive hybrid fund. So what we'll do over the next few minutes, we'll discuss the fund strategy and recap of the last 1 month. Markets, as you know, has been volatile in the last few months, and June 2025 was also no different. If you look at the key events in June, what has happened? So clearly there was a Middle East conflict which led to the oil price volatility. Crude moved from 68 to 78 back to 68 again. Also, we are nearing this 90-day deadline for this US tariff negotiations. RBI did its second rate cut of 50 basis points, taking overall reduction to 100 basis point till now. In the midst of this, markets, if you see from the start to end of the month, were up on an average between 3 to 7% across the indices. Coming to hybrid funds, I think clearly, if you look at different studies, clearly they suggest that asset allocation is more important than timing the markets. Hybrid funds give you diversification across asset classes, and I think the allocation between the assets is based on internal framework which is in tune with our fundamentals and also relative valuations. Rebalancing is on autopilot across cycles, and investors don't have to bother about timing the market. Net hybrid funds gives diversification across asset classes, participation in the equity market, and debt allocation gives downside protection and lower volatility. So let's go slightly in detail. So if you look at aggressive hybrid funds, returns typically are led by two factors. One is the asset allocation, and second, what we buy within the equity portfolio. As the name suggests, equity positioning is higher in this fund, and if you look at our history, we have been maintaining equity percentage anywhere between 65 to 75% depending on the valuations. Taxation is equity taxation for this fund, and equity portion, if you look at it, it's more like flexi cap fund. That is, we have freedom in terms of allocating stocks across the market capitalization. However, given the investor profile, what we have done is we have kept the equity portion largely large cap biased, and equity portion, the actual equity portfolio is built on bottom up basis, while we do keep cognizance of the benchmark. Our style is to buy more quality companies up to a reasonable valuation. Portfolio changes, if you look at last 1 or 2 months, so given the market movement which was upwards, we have reduced the equity percentage over the last 1 month. Currently, it's roughly at around 75%, so about 2% reduction, I would say. Key overweights continues to be financials, within that banks, NBFCs and capital markets. Also auto, aviation, pharma, telecom, utilities are our some of overweight sectors. On the underweight side, we are more underweight on the cap goods, FMCG and insurance. We also have a decent weight on the consumption as a theme, which is X of FMCG. That includes building materials, consumer durables and retail. So if you look at the performance, what has worked, I think the overweight calls on the capital markets, pharma and NBFCs have helped in the recent period, while I think IT and building materials has impacted the recent performance. Key changes, if you look at, so we have reduced weights, some in real estate, some reduction in pharma and also on the bank side. And the addition is largely on the ferrous and the retail side. So I think that was it for this month on the aggressive hybrid front.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.